who is the head of equities and lead India strategist at Spark Capital. Prior to joining and heading the equities business of Spark Capital, Ganesh held a role as, bank head of was a lead bank analyst and head of research. And before joining Spark Capital, he worked as a commercial banker with HSBC and Standard Chartered Bank for about 7 years until 2006. So he brings with him a strong profile in equities and as a strategist, and his acumen in certain industries have been well and truly proven. So Ganesh is here to talk to us about his views from a strategist point of view and consideration of whether India will embark upon a capex cycle, which we're all interested in.
Morning, Shiva. Guru, it's great to speak to you, all of you. This is Ganeshram, and I think Shiva has given a good background on Spark and on myself to you. So thanks for the kind words. I'm going to share my screen now, and I'm going to start presenting my note on India strategy, India outlook. So just hold a second. I'm going to share my screen. I hope my screen is now visible.
Yes, Ganesh.
Yeah, great. So just a quick heads up. What we want to discuss out here is what's forefront of people's minds, which is how will India be impacted due to the war and how the oil has spiked. And there is a broad consensus view that oil going past $100 per barrel will impact India. We dived into data and we are kind of concluding that you need to question the wisdom there. It's not as simplistic as it's made out to be. Second one is central banks have started hiking rates, and how has India reacted to rate hike cycles in the past? How has bond yields are going up? How has it impacted outlook for equities? Let's just discuss both these to start with. And then I'll go on to why we think growth will recover in India, why the capex cycle will pick up, what gives me confidence. That's the focus of today's conversation. This slide is important in the sense India has seen two oil spike cycles in the last 20 years. One started in 2002, around late 02, and oil was about $23 a barrel. And if you all jog your memory a bit, you will recall that 9/11 had happened in 2001, and in the next 12 months there were view that world was heading into a protracted war across geographies. And early 2003, the war went into the Iraq territory, and the view then was that will now further deteriorate in situation. Oil spiked to $34, which till then we had never seen $34, and $34 was a significant worrisome number for us back then. This is early 03. If many of you were in the markets, you'll remember that the headlines then were very similar to what we see today in terms of how oil can derail the recovery in India. It was a very nascent, and India was a kind of a virgin territory back then, and the view then was this will derail India's recovery. And the fact is, oil went up, kept going up. It went up to about $40, about $50, about $60, about $70, and went up to even $80. And I can tell you, having been in the markets through that entire period, every $10 spike, the headlines were same, that this will now bring inflation, interest rates, bond yields will go up, currency will depreciate, margins will be at risk, growth at risk, and multiples at risk. And in other words, equities will not do well. Was every $10, that was the alarm which rang. But the fact is, through this period, even though bond yields went up, and for sure inflation went up, bond yields went up. And if you see November 2003, bond yields were 5.1% in India, the 10-year government bond yield, I mean. It went up to 7.9%. But what happened to Nifty? 1,000-point Nifty November 2002 ended up about 6 times higher in 5 years. The PE multiple, let's look at factual trailing 12 months actual earnings and multiples based on that. Initial reaction to oil spike was multiples corrected, but over the next 4 years, it went up to 20 odd times. Current account, we had a surplus when oil was down, and it went up to a deficit of 2 to 3% as oil went up. But that didn't stop the forex reserves from going up from $68 billion to about 270 odd billion dollars. In spite of oil going up, as you can see here, 23 to 87, I'm talking. So it's almost like 3.5 to 4 times jump in oil has not impacted forex reserves growth, has not impact. Look at the INR against US dollar movement. It was stable for a long while, and it appreciated 20% in that period, even though oil was up. So in other words, what I'm trying to highlight to you is it's not a necessary data doesn't prove that just because oil is spiking, everything will deteriorate in India. The first order impact, of course, is negative. Okay, inflation will go up, oil imports in value terms will go up, but the second order impact, does do we get foreign exchange flows? Does exports improve? Does the Indians, as you know, teeming millions living abroad, do remittances pick up? Does foreign direct investment flows pick up? And can that offset oil? And can it still lead to growth reviving? That's one question mark. Whereas if you look at the 2009 to 15 cycle, okay, oil was $40 recovering from the financial crisis. Okay, it shot up almost 100% in the next 12 months and another 50% in another 12 months, and it had gone up to about $120 odd dollars, and it stayed broadly there for the next 2-3 years. And I mean, till about 2014, when it was still about 110 115, and then it started coming down. So it's almost like 3 years it was in that horizon, in that band. What did we see? The first 12 months, if you see, okay, Nifty gave great returns coming off the crisis. Multiples doubled in spite of oil doubling. Okay, current account deficit from almost zero went up to 3%. Forex reserves went up. The rupee appreciated. Okay, but the next 3 to 4 years, PE multiples corrected sharply in India. The Nifty gave no returns for almost 4 years. The rupee capitulated. Actually, it fell 50%. To a brief while, even fleetingly, rupee touched even 67. It had fallen 50% in almost 24 months, something we had never seen before. And India was called Fragile Five. Now, here again, oil went up 3 times, but we reacted heavily negatively. So what I wanted to highlight and bring to your attention is, in one cycle, oil has gone up 3-4 fold. We almost shrugged off its impact. And in another cycle, oil has gone up the very similar 3-4 times, and we were significantly impacted. Why this dichotomy? What is similar today? Which cycle is similar? Is it this cycle or is it this cycle? And our judgment, and this is where it's judgment on not the quantitative numerical impact, but the qualitative judgment which goes behind it. And that's a critical point. I think the key point here is, we think this was early cycle and we think this was late cycle, and that's where we think the ability to withstand the shock and still not let growth get impacted gets into action. What we, in other words, mean is, in an early cycle, the systemic liquidity is in surplus territory. Is it surplus now? Material surplus now. Early cycle, corporate balance sheets are low on debt again today. As credit growth significantly picked up, obviously when leverage is low, credit growth hasn't picked up, and that it's not a leverage fueled growth which has already lifted the tide. Okay, no, it's not yet. So it's still low tide. Inflation has not fueled up the earnings. In other words, at the top of the cycle, which is what we were in 2011 or 12, liquidity is negative, leverage is almost to the nose. India had leverage back then, and at that stage you get a shock. market's reaction is very, very, markets react negatively. The second is central banks react negatively because they see capital outflows. Their primary job is to protect the rupee. They see rupee outflows. They see, India is vulnerable to a current account deficit spike, and what they want is they want to bring the current account deficit in control, and the only way to do it is to cut growth. So they take monetary policy measures which have a huge impact on growth, negative impact on growth. So that's the characteristic. So oil cannot be seen in isolation. Oil has to be juxtaposed with how other variables are stacking up. And in that context, the way the stars are aligned today, we think India can absorb the oil shock a lot better than we managed in this cycle. So we will not want to correlate it to how things were in this cycle. We think a lot of the economy front resonates with how things were here. Okay, economy is, what I mean is leverage levels of balance sheets of corporates, how the banks' balance sheets are looking. Their banks have cleaned up the balance sheet, provisioned extensively. They've capitalized the balance sheets very well. So corporate balance sheets, household balance sheets, banks' balance sheets, forex reserves, systemic liquidity, interest rates, all those do not point to any vulnerability to oil, even if oil continues to be at elevated levels. This is a very, very important point. But where I think this cycle is also not too relevant today is valuations. Okay. Trailing 12-month earnings, price to earnings multiples, if you see the cycle starting point, which is November 02, India was about 12 times, 11.9 times. And 6 months later, we were at less than 10 times. And 2 years from the cycle starting point, which is say November 04, we were at 13 times. India, when COVID hit us and the markets corrected, we were 12 times trailing earnings. So cycle starting point on valuations are very similar. But 2 years from then, where we are today, India is at 20 times already. So a large part of the significant returns have already, in terms of valuations, have already come. Earnings haven't come. So where we think is from now to the next 3-year scenario, we are very confident of India absorbing the oil shock. India, we will see growth revive, capex cycle revive, earnings leverage play out, operating leverage play out. But we don't see there is much upside to valuations. In fact, when we are picking stocks in our model portfolio, we are working with valuations potentially having downside. And can earnings growth offset it is the question, the key question that we are asking when we are picking stocks is, what is the long-term average of valuations of this? Not just PE multiples, but it could be price to sales, price to earnings, it could be EV to EBITDA, it could be price to cash flows, or it could even be terminal value as a proportion of market cap. How much is it today? What is the long-term average? Can it mean revert? And we will work with a view that valuations will mean revert in the context of how global external liquidity, as central banks start tightening, that could have a moderating impact on valuations. But earnings is where I get my maximum comfort. So in other words, to conclude this slide, we don't think either of these two cycles are absolutely relevant in how we think the current cycle is. We are not going to see either of them repeat, but we have learned a lot from each of these cycles on what we should pick and not pick. I'll just maybe take a pause on this slide because this is a very critical, and from my experience, a lot of funds have a lot, especially from people who look at India from a distance. The further you go from India, the questions are more and more on oil and how all the macro variables can impact us. So happy to just take a pause here. If any of you have any questions, happy to immediately clarify this point to you. If okay, I don't hear any questions, so I guess there isn't any. I'll just jump to the next slide, which is something related, which is central banks have started hiking rates, and how has India reacted to bond yields going up, interest rates going up. Just to highlight to you, 2001 bond yields in India were 10%, and over the next 24 months, bond yields came down quite dramatically. Okay, it came down, almost till about 6.5% or thereabout. So it fell 350 basis points. Markets gave no return, negative return. Okay, then it fell even more. It fell to 5%. Markets gave phenomenal returns in calendar 03, 2003. Uh, Around late 03, bond yields bottomed out. It stayed a bit low here till about mid 04, but by around September 04, US Federal Reserve started hiking rates. Okay, and bond yields in India started going up. Okay, if you see here, multiples corrected, but earnings growth were very strong and markets gave good returns. And even though bond yields rose from 5% to 8% by 2006, central banks globally were in a rate hiking mode in this period. But inflation was high in that period. In the sense, commodity prices were rising, oil was rising, as I showed you, steel prices were rising, and in general, we had an inflationary environment. But what I want to point to you is in that period also, even though bond yields went up from 5% to 8% and stayed there for a next couple of years, look at the stock returns the Nifty showed in that period: 72%, 11%, 36, 40, and 55. And it was, and I'll actually break down it, how much came from earnings growth: 38%, 28%, 9%, 36%, 20%. This was Nifty's earnings growth in those 5 years. So what I'm trying to highlight to you is, even though interest rates went up 300 basis points, growth didn't get impacted. I mean, earnings growth didn't get impacted. Or in other words, in this period, even though interest rates came down 300 basis points, we didn't see markets give return. Not necessary that re-rating happens in that period. So when I juxtapose margins and earnings, and multiples, I will not want to conclude that in an early cycle of rates going up from abnormally low levels to normalcy returning to bond yields, not necessary that it is a negative for equities. So I find again investors asking me repeatedly, will central banks have now started, bond yields will start going up? Will it impact the rate sensitive stocks and growth, their growth rates and multiples or earnings? It is not necessarily a scenario, which again, I think I wanted to kind of question the wisdom which the street tends to have on these fronts. In fact, even in the subsequent cycle, 2013 bond yields in India were 9%, and it fell to 6% in the next 3 years. It fell 300 basis points, but we didn't get great returns in that period, both in terms of earnings growth and our market returns. It was one good year, but 3 bad years, and net not much return in that period of time. So again, I wanted to, there is data which tells us that not necessary that just because bond yields are falling or bond yields are rising, it's good for earnings or returns to be had in equities. I just want to stop here. Any questions again on these, because these are questions which are top of the mind for many investors. So I just wanted to present these to you. Stop me if you have any questions, happy to clarify them.
Yeah, I have a question, Ganesh.
Sure.
So, the analysis that we are doing is on Nifty, which is the top 50 stocks by market cap. Given that most people tend to invest in India in an active manner, even though there are some ETF and passive proponents, what do you think the landscape looks like for active managers versus Nifty?
Fair point. Okay. In fact, on that, actually, the returns, if I were to draw the similar, I actually have that table. I didn't put it in the note because I didn't want too many data points and cluttering the. But to conclude, uh, the the beta is higher with the mid caps, okay, or largest mid caps. What I mean is the returns on mid caps in this cycle were even more than Nifty was. So even though rates went up, mid caps growth rates and stock returns, earnings growth was much better. So whereas on the way down, mid caps they underperform even more. So in this period, which I've circled here, uh, the mid caps capitulated. The equities were the top 50 stocks didn't give any great return, but if you break that down, it was staples led. It was IT sector and staples which gave the return, or maybe some pharmaceuticals. So the defensives, but the mid caps got pummeled. So the mid caps will be a higher beta, and that's where the kind of exaggerated upside and downside will be seen on these fronts.
Yeah.
Does that answer your question?
Yeah, so I guess I'm trying to reach a conclusion whether the next investment period will be good for active managers or not.
I think so. In fact, that is actually my call. The view on the macro I presented to you. In fact, I'll just step into the investment cycle, and this is where a lot of mid caps become relevant. When I look at the corporate balance sheets to start with, net debt to equity is at a 15-year low. In fact, I have data. I've presented 5-7 years here, but its net debt to equity is at a 15-year low. This is BSE 500 companies, the top 500 companies in the country. If I look at our coverage universe, we cover about 225 stocks. I eliminate the financials, about 195 stocks. The debt, total net debt is about 6.9 trillion rupees, and invested capital is about 34 trillion rupees. So you currently have a situation where net debt as a percentage of invested capital is just 20%. In other words, equity is 80% of the capital. This kind of 80% of invested capital from equity is unprecedented in India. It's 50-50 normally. Today it's at 80-20. And that is where balance sheets are so strong today in terms of how well positioned they are, how deleveraged they are. And when I then look at, this is for fiscal 21 March, and fiscal 22 and fiscal 23, when I add up the free cash flows, the low level of debt which is there, and which means deleveraging, there isn't much left. We think it has very high chances of going into investments or capacity expansion. Now you can ask me what indicators you have to get that conclusion. We think there are a lot of indicators. Now, one thing which I always track is environmental clearances. That's a very strong lead indicator. In the last few years, especially during the COVID period, as the China plus one initiatives have, the government is extremely, in fact, the trade minister was in Australia as we speak, I think this week, and you can see the government is very, very clearly focused. And I speak to bureaucrats, the level of seriousness they have on this is very, very clear. They want to get the manufacturing cycle up and running in the next. They should have had it by now. COVID has delayed it, or it's happening, but I think it's got a little protracted. But over the next 2 years, you will see this government pressing the pedal in terms of getting the investment cycle up and running. And one of the key lead indicators is the kind of environmental clearances they have granted. And somebody is sought for it and got it. And that grants today will translate into factories being put up, or mining being done, or new, all these are the China plus one initiatives, which will, and again, that also tells you in another data point, in terms of new registrations, as in new companies being formed, manufacturing companies are now 22%. They used to be for 25 years, around 12%. India was a services dependent economy. what you are now noticing is a big shift trend towards manufacturing. And I think that's possibly the one of the most important changes which I'm noticing here in the landscape on the ground, that the manufacturing delta is beginning to be seen. All the last 5 7 years on rhetoric on make in India and all these initiatives are China plus one, and you might have heard of India's phrasing, coining a term called Atmanirbhar, which basically means self-sufficiency and reducing our imports from China and increasing our exports into the rest of the world. That's, I have data points to tell you that it is indeed beginning to play out, and this is noticing. In fact, on that point, I'll just show you one important point. Look at how our exports are growing. Okay, I'm looking at pre-COVID to today, so that the first year of COVID, fiscal 21, the growth capitulated, and that shouldn't be the base in which I do the analysis, because it will show abnormal growth. But look at the growth in our exports in the on a 2 year CAGR. Okay, look at the, in fact, the categories: engineering exports, or it could be on chemicals or agriculture, or even India's export of jewelry, uh, uh, even textiles. And also look at the countries where it's going to. It's not going into China or Hong Kong or the Middle East. It's going into US or Europe. It's going into even Bangladesh, which manufactures the textile garments, which goes on ultimately to the Western world. And this is what I'm looking at. The export potential is dramatically improved post COVID. I think that's a very, very important point which I wanted to also highlight. Investment intentions from India's private sector, it's the highest since 2012. It tells you that people are planning for capex, and that's manifested in both these data points as well. I also wanted to look at capacity utilization in that context. Sectors like textiles, 84%, cement, 75%, steel, 86%. Companies need to start planning for capex, because it takes about 24 months to 30 months, even if it is a brownfield expansion, to get the factories up and running. It takes longer, but we see the momentum picking up there. I also look at capex announcements, the large corporate, mid corporate, small corporate, and I then break it up sectorally. Sectors like steel, renewable power, and electronics, we find a lot of very strong momentum on capex announcements, and that gives us confidence on the capex cycle as well. Then that's all on corporate capex. I also want to look at property cycle, and what I will highlight to you is, these are about 5 cities in the tier 1, and there are about 15 tier 2 cities in India. Unsold inventory, as in unsold inventory of houses, it's about 2 years of sales currently. We last saw this around 2013, and since then the inventory was piling up here, and gradually post COVID we are seeing the inventory getting kind of absorbed by the, which means demand is recovering. On the other hand, you look at supply, which is in the form of new launches, and I again look at tier 1, tier 2 cities, it's halved. So in other words, supply is halved, but demand is now recovering. This means pricing has to pick up, because demand is now much more than supply. Better pricing will lead to supply coming, and when supply starts coming, you will start seeing demand for cement or steel, and laborers, building materials, paints, tiles, all the, and the multiplier effect of housing is very high in the economy, as you will all appreciate. So this is the second capex cycle which I'm confident in. The third is data centers, and this is an interesting new, maybe a niche segment, where Indian government has been telling the Amazons and Googles and Facebooks to store data locally and not just store it abroad. So what we are noticing is a surge in already just $16 billion worth of announced investments in this, and I think this will pick up even more. Also, in the context of this, I will highlight you. I'm not sure if you've all heard of this phrase called PLI, which is often in the media. What India is doing is production linked incentives, incentivizing multinational corporates to kind of fast track and put up manufacturing facilities in India and diversify from their sources of manufacturing in China. This is public information in the government's website. 70% of them are multinational corporates who have announced intentions over the next 4 to 5 years to do capital expenditure of about 4.4 trillion rupees directly uh, into these 15 segments where the government is incentivizing them to put up facilities and make it kind of economically more viable, and that means companies can diversify their supply chain, and we are very positive on this. On the ground, the feedback which we are getting is the companies find it very interesting. There's a lot of seriousness on this, a lot of action, which we think as travel picks up over the next few months, we think this will be possibly the most interesting thing which India could see. So in other words, capex cycle, be it corporate capex, property capex, exports led, government's infra focus, I think all these will lead to investment cycle picking up, and that's where our portfolio bias is significantly sitting on. I will also want to highlight to you one more point before I pause, which is how the jobs and the consumption could play out. Look at jobs, and since COVID, we have been seeing jobs improve to well beyond what it was pre-COVID. I'm looking at monthly new jobs being created. EPFO is the monthly social security, what in India we called as provident fund, new registrations. That means new jobs, and the net number is at a well almost a 50% beyond what it was pre-COVID levels. And also I also break it up sectorally to see if there's any concentration. Except the hotel industry, as we all know, travel has been impacted. Every other sector has seen pretty strong hiring pattern, and we have also seen the highest wage hike we have ever seen in India. It's at almost a 19% wage hike that we have noticed in the first 9 months of this year, which is why when we study the salary costs of all the stocks that we cover, except transportation and hotels, as and they're no, they have been impacted, so their wages have come down. We have seen improvement across the board on jobs and wages, and that bodes well for consumption, which is why when I study household balance sheets, I look at in India, you would have often heard we talk in a banking context of CASA, which is the low cost deposits. It's not just low cost, it also gives you a sense on how household balance sheets are. It gives you a lot of data on what they spend on, and banks use the data and intelligence to take better credit decisions. But what I am in the context I am drawing is the incremental savings bank balances in the two COVID years, okay, is almost 80% higher than what it was pre-COVID. And unless we had jobs and wages go up, this wouldn't have happened. And the magnitude is very, very high. It's 15 trillion rupees if you add up these two together, and almost getting there, 13 point something. So what I'm basically telling is, where has this money come from? It's come from India's got $200 billion forex reserves accretion, and IT companies have got more business. India's got more foreign direct investment. For India's got more remittances from the non-resident Indians. Foreign portfolio flows were strong, especially in the first 12 months. And all this has led to somebody in India getting this money. And this is 15 trillion. And this is why you find banks sitting on excess liquidity, and that is the cushion we have to absorb an oil shock as well. So it bodes well for consumption recovery as well. So when it comes to broader recovery on the economic side, consumption and capital expenditure, the investment cycle, we are confident on both, and that's an important part. which I will want to highlight. I think on the broader India picture, all these are the data points I track and I get my confidence from. Happy to take your questions and if you have any more further clarity, you want me to dive into anything detail, happy to.
I think, Ganesh, given the interest of time, what we'll have to do is circulate back to our listeners and come back to you with questions.
Sure.
Yeah, unfortunately, timing-wise, I think we have come past that, and due to the last session, which was quite interesting, and your session, which was quite interesting as well. So what we'll do is we'll circle back to you with some questions. It's definitely interesting and different to perhaps where some of the other economies are, particularly in the Western world. And I think the more transparency that people have into looking deeper into India will give them more confidence, like you have yourself, by looking at the numbers, which will then allow them to consider investing rather than look at the headlines like rising oil prices is negative from a macro perspective in history, but the context is not there of where you are in the cycle. As I've read your stuff is quite relevant.
Correct. Fair point.
Yeah.
Great.
Thanks
for your
very
time,
much.
all of you. Pleasure speaking to you all.
Thanks a lot.